right, put that textbook away. Seriously, we are literally replacing it today. Welcome to a complete masterclass on the fundamentals of investment research. If you're prepping for your exam, you are in the exact right place because we're covering absolutely everything from Chapter 4. I'm talking every single topic, subtopic, definition, and crucial exam point. We're going to walk through this step by step so you walk away with total mastery. Let's dive in. Here's our roadmap for this explainer. We'll kick off with investing basics, move into research ethics, break down the 4 approaches to analysis, decode commodity fundamentals, do a deep dive into gold and crude oil, and wrap up with market impacts and exam prep. Okay, it's Section 1, Investing Basics and Strategies. We really need to distinguish between long-term wealth building and short-term trading. Notice the hard line drawn here because it's an absolutely crucial distinction. Investing isn't just buying something. It's a real upfront commitment of capital over a long horizon. Your wealth creation is driven purely by the asset generating higher intrinsic cash flows over time. Trading and speculating, that's a whole different ballgame. They operate on a much shorter horizon, usually under 3 to 6 months. Traders are just trying to earn a profit by capturing a spread between the buying and selling price. They're motivated by historical price patterns and anomalies, and honestly, they don't really care if the fundamental value of the asset changes at all. So investors equal long-term wealth, while speculators equal short-term price moves. Now, within that short-term world, you get some wild tactical extremes. First up, the chartists. These guys rely entirely on historical price patterns and specific charting techniques to guess market moves. Then you have day traders. For a day trader, their complete investment and disinvestment cycle happens within one single trading day. They absolutely refuse to hold positions overnight, making sure they close out everything before that final bell rings. So what's your overarching strategy going to be? Active or passive? Active investing is, well, intense. You're constantly evaluating your portfolio to find under or overvalued securities. The whole point is to buy below intrinsic value and sell above it to beat the market. The catch? It takes massive effort, racks up huge transaction fees, and is really only for highly risk-tolerant experts. Passive investing, on the other hand, is like indexing. You just buy a broad set of securities to represent an entire asset class. You'll never beat the market, but your transaction costs are super low, making it incredibly suitable for long-term, cost-conscious retail investors. But hey, how do you legally find the data to execute these strategies? That brings us to Section 2, Research and Information Ethics. As a research analyst, your core job is digging deep into information sources, reading annual reports, doing primary research like visiting facilities, talking to suppliers, the whole shebang. But there is a massive ethical boundary you have to memorize for your exam: insider information. Specifically, material non-public information, or MNPI, is highly price-sensitive and strictly illegal to trade on. Think of a CEO secretly discussing an unpublished acquisition. You can't touch that. Mosaic analysis, however, is your best friend. It's totally ethical. It's the art of puzzle solving, combining public data with non-material, non-public info, like noticing a ton of extra delivery trucks at a warehouse, to form a brilliant, completely legal investment thesis. All right, let's look at how we actually crunch the numbers. Section 3, the 4 approaches to analysis. We're kicking things off with technical analysis. The core assumption here is pretty bold. It assumes all company fundamentals and economic factors are already perfectly baked into the stock price. Because of that, technical analysts literally throw the balance sheet out the window. Instead, they focus purely on forecasting price direction by studying historical price, volume, and time horizon. Why? Because to them, price and volume are direct visual representations of market psychology and the endless tug-of-war between supply and demand. To map out this psychology, they use line, bar, and candlestick charts. Candlesticks are super important because they pack 4 data points into one visual: the open, high, low, and close price. Now, the daily market is noisy, right? To cut through that, analysts use moving averages to smoothen the daily fluctuations. They're always hunting for support, which is basically a floor where strong buying interest stops prices from falling, and resistance, a ceiling where selling interest pushes prices back down. Exam tip: when a price breaks through support or resistance with heavy trading volume, that confirms a trend breakout. But if it bounces off, that's a potential trend reversal. Now for a complete 180-degree turn, fundamental analysis. This is all about the long game, working on the premise that an asset's true intrinsic value is driven by its ability to generate profits and cash flows. You want to exploit market mispricing by buying when the market value drops below the intrinsic value. But keep in mind, this directly contradicts the efficient market hypothesis, or EMH. The EMH argues that share prices flawlessly and instantly incorporate all relevant information, making it theoretically impossible to consistently find mispriced stocks. If you are doing fundamental analysis, you follow a strict top-down process called the 3 baskets. Step 1 is economic analysis, looking at the big picture cyclical and secular macro trends. Step 2 is industry analysis, where you gauge competition intensity and overall sector growth. Finally, step 3 is company analysis. This is where you get into the weeds, assessing the cost structure, specific financial strength, how they fund their growth, and critically, their management quality and corporate governance. You really want to know how well the board protects its shareholders. The last 2 approaches are quantitative and behavioral. The quant approach is heavy math, using econometrics, regressions, and time series data. But watch out, it has a massive limitation that they love to test. Frequent changes in accounting standards and business structures make historical data completely incomparable. It breaks the models. Finally, the behavioral approach. This one just acknowledges that humans aren't rational. Cognitive biases, specifically fear and greed, consistently push securities far away from their fundamental fair values. Okay, let's transition our toolkits away from stocks and into the physical world. Section 4, Commodity Fundamentals. Unlike corporate equities, commodity prices are driven strictly by raw global supply and demand. Supply means physical production from farms and wells, but also extreme weather, geopolitics, and input costs. Demand is driven by GDP growth, urbanization, and seasonal shifts. Now, how do macro factors play in? Well, when inflation rises, commodities like gold act as a hedge, so their prices go up. But if interest rates rise, that strengthens the US dollar, which actually pushes commodity prices down. And to track industrial demand, we always watch the Purchasing Managers' Index, or PMI. Let's apply this. Section 5, Gold and Crude Oil Cases. These are the 2 absolute heavyweights of the market. Look at gold. It's fascinating because a massive 47% of global demand is just jewelry. Investment takes up 24%, and central banks hold about 23%. The top producers globally are China, Australia, and Russia. So what pumps the price of gold? Expansionary monetary policy, a weaker US dollar, and higher inflation are all huge positive drivers. Crucially, during economic turbulence, gold moves inversely to stocks and bonds. It is the ultimate safe haven asset. Then we have crude oil, literally the lifeline of the global economy. For the exam, you have to memorize the quality differences. WTI, traded in the US, has an API of 39.0 and very low sulfur at 0.24%. Brent oil from Europe has an API of 380 and 0.4% sulfur. Global supply is heavily concentrated. OPEC is the big boss here. They control 40% of production and a staggering 75% of proven reserves. So when OPEC limits production, or US rig counts fall, or the dollar weakens, oil prices shoot up. But history shows us that extreme shocks can completely wreck your pricing models. Take the 1973 oil crisis. OPEC literally quadrupled prices to $12 a barrel and embargoed the US and Western Europe. Fast forward to April 20th, 2020. Get this. COVID lockdowns destroyed demand so badly that the WTI May contract actually expired in negative territory. People were paying buyers to take the oil because there was absolutely no physical storage left at the delivery point in Cushing, Oklahoma. All right, let's bring it all home. Section 6, Market Impacts and Exam Prep. How do physical commodities actually impact the stock market? Well, commodities are raw materials, right? So their price changes instantly hit corporate profit margins. If crude oil prices spike, airlines and logistics companies get crushed by the input costs. But oil-producing companies get a massive boost. Commodities are also leading indicators. Falling copper prices, that signals a major slowdown in global industrial demand, and it's definitely going to drag down metal and infrastructure stocks right along with it. Okay, let's lock in that textbook knowledge we just built with some rapid-fire practice. Question 1. Speculation is a blank call made with leveraged funds, unlike investment, which is a blank disciplined activity. Think back to our very first section. The answer is A. Speculation is a short-term leveraged call, while investment is a long-term disciplined activity. Moving on to technicals. Question 2. In technical analysis, the impact of day-to-day fluctuations in prices is smoothened by which of the following factors? Remember the tools chartists use to cut through the noise? Yep, the correct answer is C, using moving averages. Last one, question 3, a classic limitation question. Which statement about the limitation of the quantitative approach to fundamental analysis is correct? As we discussed, pure math models often break because of B, frequent changes in accounting standards and business structures make historical data totally incomparable. And boom, we have now covered absolutely every detail of this chapter. So here's my question to you. For your next investment, are you going to rely on short-term price charts, or are you ready to dig deep into intrinsic fundamental value? Think about it and keep studying. All right.